Good evening, friends. Welcome to this wonderful chapter Ind AS 1 again. Ind AS 1 is presentation of financial statement. Very easy topic. Come to question number 11. Any query till now?
No, sir.
Very easy topic. Today you will just, after the class is over, revise in 10-15 minutes quickly. X Limited found a material error, significant error, which can influence the decision maker of the users of financial statement, that is material error, in its financial statement for the year 2021-22. How should X Limited present its financial statement for the year 2024-25? So we are here 2024-25, that is our current financial year is 1/4/24 to 31st March 25. We'll have to give a financial year, comparative financial year 1/4/23 to 31st March 24, because there is an error which was committed before this date. The error was committed before the 1st April 2023. We will have to give one additional balance sheet, and in that additional balance sheet we have to give the effect of this error, adjust the opening balance of retained earning or whatever respective reserve and the respective asset or liability. So that figure will be adjusted. We are not required to give financial statement of period before this date. So 3 balance sheet will be prepared. Balance sheet as on 31st March 25, balance sheet as on 31st March 24, and balance sheet as on 1/4/2023. 3 balance sheet will be required to be presented, and in this balance sheet, opening balance sheet, you will give the effect of that error, rectify that error. So now we'll come to the answer part of it. Is it printed in the book?
No.
If the answer is not printed, please note it down. Please note down the answer. Small question they will ask in one. Suppose question number 5, they may give A, B, C, D, and they can ask this question as a part of a bigger problem for 8 marks or 6 marks. So don't think small questions are useless. If the error occurred before the earliest period presented, that is 2023-24, restating the opening balance of asset, liability and equity for the earliest period presented. Restating the opening balance sheet of asset, liability and equity for the earliest prior period presented. That is 1/4/2023 as per Ind AS 8. the entity shall restate its balance sheet. The entity shall restate its balance sheet on 31st March 2023. It shall present three balance sheets. It shall present three balance sheets. That is balance sheet on 1/4/2023, 31st March 24, and 31st March 25. 31st March 25. Okay. So that was an important point about frequency of reporting and comparative information. Another important thing in financial statement presentation is consistency. What is consistency? Same presentation, same accounting policies, okay, should be followed. Accounting principle, accounting policy, presentation should be followed consistently. What is the benefit of consistent application of accounting presentation policy? Comparison will become easier. It will become reliable also. It will be, you can compare with other entities also. And if you keep changing the presentation year after year, then earlier year cannot be compared with the current year. And then it will lose its relevance and reliability, which is very important attribute of financial statement, relevance and reliability. So it should follow consistently accounting policies, then even method of calculation like FIFO method for inventory valuation, weighted average for inventory valuation, that should be followed consistently. Even whatever items you are including in calculations, those should also be consistently followed. So at the same time, it should also retain the same presentation and classification also to ensure consistency of presentation, right? Unless standards cannot be rigid. Okay, remember, even in your AS1 long back, when you were small kids, okay, you are allowed to change accounting policy in three situations. Which three situations? AS1. For better presentation, change in law, change in accounting policy, change in accounting standard, change in accounting standard. So here we also allow you to change the accounting policy if the change is due to change in the nature of the entity's operation. So presentation can change. For example, we are talking about presentation here. You are using a building for own business. Later on you have given the building on rent. So its presentation will change now. Its classification will change from PP to investment property. So that is because of change in the nature of the entity's operation. Financial instrument which was classified as FVTPL in some circumstances can be changed to FVT OCI, fair value through OCI, or vice versa. That we will discuss in Ind AS 109 when it can be changed. So in that case we can change it. So sometime it is possible. Or for example, you were earlier selling cars, so that was your inventory, but then you have decided to use some cars for rental business. It will become PPE item now. Is it right? Or you may use some car for the senior management people. So it will become property, plant and equipment. So that way, sometime due to change in nature of operation, we can change the classification, then next is another presentation or classification would be appropriate. If the management thinks that changing the presentation or classification will give a better understanding of the financial statement, users will benefit more with the revised presentation or classification, then they can do it. And the next reason you can change is Ind AS requires such a change in presentation. Like some years back, which you will remember probably, Ind AS 116 was issued. What is Ind AS 116? Come on, leases. So under leases, old standard used to have two types of leases in the books of lessee: finance lease and operating lease. Under this new standard on leasing, there is no finance lease and operating lease classification in the books of the lessee now. It is in the books of lessor but not in the books of lessee. Rather, the lessee will show right of use asset. The asset taken on lease is shown as right of use asset, irrespective of whether it is finance lease or operating lease. Is it right? So in that case, the entity has no choice but to change the classification, okay, because the standard requires it. So standard allow you to change the classification presentation, one, if the entity's business model has changed, nature of operation have changed. Change would result into better presentation. And third, when an Ind AS requires the entity to change the presentation or accounting policies. So when changed, above requirement of comparative information applies. Is it right? So the comparative information will also be changed so that the previous year data can be compared with the current year data. No additional, that additional balance sheet may come if the change in accounting policy is voluntarily. If what you have changed falls under definition of accounting policy and that is voluntarily, then it can change. But if your business model has changed from PP to investment property, it is not change in accounting policy. So in that case, the additional balance sheet is not required. So if the change meets the definition of change in accounting policy, and if the accounting policy is changed voluntarily, additional balance sheet is required, otherwise not. So next paragraph, next feature of financial statement is structure and content. So quickly reply, whether your Ind AS gives you any format of financial statement? The answer is no. Ind AS does not give you any format of financial statement. That is given by the law of the respective country. Like we have already seen in India, Ind AS Division 2 Schedule 3 gives you format for Ind AS companies. Okay. What this standard says, identification of financial statement. That means financial statement should be clearly distinguished and identified from other information that are presented in the same published document. Try to read one annual report. It may be there in your home or you can download from any of the company's website. You will find in annual report you have director's report, management discussion and analysis, then some report on environment, some report on value addition, human resource, auditor report, then CSR related disclosure and so many disclosure, and then towards the end you will find there is a separate financial statement, there is a consolidated financial statement. You have to clearly state that this is standalone financial statement, this is consolidated financial statement, so that the user should be able to identify and distinguish it from other statements appearing in the annual report. So it has to be very clear. Ind AS are applicable for General purpose financial statement. GPFS means general purpose financial statement and not to any other published document. Already explained to you, it is not applicable to director's report, auditor's report, etc. Hence, identification is necessary. Following information should be presented prominently in the financial statement. So, as per Ind AS 1, what are the information you have to disclose so that you can identify and distinguish financial statement? Name of the reporting entity. So, you will find on every page the name of that company is written, Reliance Industries Limited, and if there is any change from the end of the preceding reporting period, if company has changed the name, Ruchi Soya become Patanjali Foods, then you have to disclose the name of the former company also. Financial statements are of an individual entity or a group of entity. So you have to clearly mention it is a standalone financial statement or consolidated financial statement. You have to give the date of the end of the reporting period. So usually you will find written 31st March 23, 31st March 22, and then you have to also mention presentation currency. What is presentation currency? That is currency in which financial statements are presented. That means the balance sheet is in rupees or dollar or pound, and in case if you have rounded off the figures, that will be disclosed, whether figures are in rupees in thousand or lakhs or million, and then you have to also write what is that component of financial statement. Is it balance sheet, statement of profit and loss, or statement of changes in equity? After that, to maintain consistency within the financial statement, the same unit of measurement should be used throughout the financial statement. What does it mean? Rupees in million, suppose you are writing, then all statement, balance sheet, P&L account, statement of cash flow, notes, SOCIE, all will be in the same unit. Okay, because otherwise it will become confusing. Balance sheet is in lakh and P&L account is in million. That is not allowed. So if any question like that is asked, you will say all the statement will be based on same unit of measurement. An entity often makes financial statement more understandable by presenting information in thousand, lakhs, million, crores of units of presentation currency. Question number 12. Can an entity adopt different levels of rounding off for different disclosures that are made in the financial statement? We are discussing Ind AS 1 right now, and the question is, can an entity adopt different levels of rounding off for different disclosures that are made in the financial statement? Option A, yes. Option B, no. The answer is no. So Ind AS 1 permits the use of rounding off. Rounding off is allowed, otherwise the number will become very big. Reliance company has, suppose, profit of 50,000 crore rupees. This is 50,000, then this is crore. If you write such a big number, very difficult to understand. So they can write rupees in, say, crore. So 50,000 crore is the profit, easy to understand, allowed. An entity disclose the level of rounding, you have to do it, and does not omit material information. In the process of rounding off, you can't hide or omit the material information, and then you have to maintain the consistency. Same unit of measurement should be used throughout the financial statement. Moreover, Schedule 3 of the Companies Act also contain an explicit requirement to use the same unit of measurement consistently for the presentation of financial statement. This is how the student will have to draft the answer in the exam, if it is a 4-mark question. Okay, but concept is that you have to use the same unit of measurement throughout the financial statement. Then you can write in your own words. Even Schedule 3 has got a requirement to do that. Consequently, entity uses a uniform unit of measurement. Okay. Answer is printed in the notes, so you don't have to write. Now we'll come to the presentation in balance sheet. The standard is presentation of financial statement, general purpose financial statement. So if you look at the requirement of Ind AS 1, it says that in the balance sheet, the assets and liabilities will be classified into two categories, current and non-current category. Okay, current and non-current. This is my requirement. This is the requirement of Schedule 3. One more line they have added, but right now not applicable in India. Right now not applicable in India because Schedule 3 does not allow liquidity based presentation, except when presentation in the order of liquidity is more relevant and provides reliable information. Is it allowed in India? No, you can't go against Schedule 3. Schedule 3 has to be followed by companies which are applying Ind AS. So the company Schedule 3 allows only current and non-current approach, but probably in future entities like banks where liquidity is important, they may be allowed to present in the order of liquidity. So most liquid item and then move towards least liquid item or vice versa, something they may allow, but I don't think that is going to happen soon. So you will say financial statement, that is balance sheet, assets and liability will be presented by dividing the items into current and non-current. Does Ind AS gives you any particular order of presentation or format? So remember, Ind AS does not give you any particular requirement of particular format, but it gives you certain minimum line item that you should present. Then from where will you get the presentation? You will get the presentation from Schedule 3, Division 2 for Ind AS company. It gives you a little flexibility. What is that? Additional line item may also be presented if so warranted by the nature or function of the item. Is it right? Our Schedule 3 is not a very rigid schedule. Sometimes if required, you can add one line item which will give better understanding. One example will help you to understand. Property, plant, equipment can be accounted using two models. One is called cost model and one is called revaluation model. In your accounting standard 10 in intermediate, there was a chapter PP, and in Ind AS there is a almost same standard Ind AS 16, because AS 10 which you have studied and come here, the source is Ind AS 16 only. So you have studied that. Don't say no. Cost model means historical cost less depreciation, and revaluation model means if the fair value changes, then they can change the value in the books of account to bring it in line with the fair value. So what you can do, you can write PPE, A based on cost model and B based on revaluation model. So those items which are based on cost model you can show separately, and those items which are based on revaluation model you can show separately. Will it be wrong? No, because additional line item can be introduced. Then next they have said in the Ind AS 1 that DTA and DTL should never be shown as a part of current item. It will always be non-current asset or non-current liability. Why? Here there is no question of current item, because deferred tax asset or deferred tax liability means this tax liability you have to either pay in future or you will recover in future. But when will you recover or when will you pay is uncertain. It is difficult to exactly pinpoint that in this year this tax liability will have to be paid or will be recovered. So considering the uncertainty involved, lot of judgment will get involved, and if lot of judgment will get involved, then some company will put current, some non-current. So standard says no problem, I will make your life easy, put all deferred tax item in non-current only, so you are free from judgment. Okay, enjoy. Then next is some discussion now which is very important for next 1 hour. Classification of asset into two categories, current and non-current, because this affects my current ratio. Current ratio indicates liquidity of a company, whether the company is in a position to pay its current liabilities and short-term liabilities or not. So by looking at the balance sheet, those users who are interested in judging the liquidity of the company, they will look at current asset and current liability. Therefore, you have to put only those items which will meet the definition of current asset and current liability in current asset and current liability. Otherwise, this can seriously influence current ratio, means liquidity figure can get affected, and therefore decisions can go wrong if it is based on the liquidity position. Understood? So once you understand the logic why current and non-current, then you can understand the meaning of current asset. So current asset, and first we'll see current asset, then we'll see current liability. An asset is classified as current when, you see there are four meaning of current asset, four arrows are there in your book. If any of the four condition is satisfied, any of the four, then it is a current asset. And if all the four conditions are not satisfied, then non-current asset. No separate definition for non-current asset. If it is not current asset, it is non-current asset. Okay? So first is those assets which are expected to be realized. Realized means, for example, trade receivable or debtor, which are expected to be realized or sold. Example of sold, example finished goods, inventory, or consumed, example raw material, WIP, in the normal operating cycle of the entity. In the normal operating cycle of the entity, normal operating cycle means the time required to convert cash into raw material, raw material into WIP, WIP into finished goods into debtor, and debtor again into cash. Because the nature of the business is such that this much time is required to convert your cash into cash, then any asset which will be realized within this normal operating cycle period or will be sold or consumed in this normal operating cycle period will be treated as current asset. Example, only example, receivable. It can be anything more also. Inventory. If these are expected to be recovered, realized, consumed, sold in this normal operating cycle period. Normal operating cycle period can be suppose 15 months. Then in that case, if your stock, debtor can be realized or sold within 15 months, still they will be called as current asset. still they will be called as current asset. If normal operating cycle cannot be identified, then 12 months will be treated as normal operating cycle. If a company has different businesses, you have construction business also, wine manufacturing also, and normal soaps and detergents also. So construction may take 3 years, wine can take 18 months, soaps and detergent 12 months. So will you have only one operating cycle or 3 operating cycles? Yes, you have to identify assets dedicated to these 3 businesses and check according to that business model. So if you have multiple businesses, companies are diversified company which have different operating cycle period, then for each business will take the separate operating cycle according to that business. Okay. So first point is, if it is expected to be realized, sold or consumed in the normal operating cycle period. Next is, it is held primarily for the purpose of trading. That means primarily for the purpose of trading means the objective is to buy and sell. Here we will not look at the time factor. If you have bought something for the purpose of selling, it is trading, and if it is meant for trading, any day it can be realized now, because you have kept it on the shelf. Any buyer can come, pay the price, you will sell it. So such items are always current, which are held for the purpose of trading. No time condition. Example, your basically finished goods, stock in trade. Then those who are trading in financial asset for trading purpose, those who trade in shares, those who trade in derivative, okay, then they will call it as current asset. And the third category, there are so many other assets. How do you check whether they are current or not? It is expected to be realized within 12 months after the end of the reporting period. Expected to be realized within 12 months after the end of the reporting period. Now, if normal operating cycle period is, suppose this is my year ending date. If I apply the first condition, normal operating cycle, it will realize on 31st March 26. If apply third condition, it should be realized by 31st March 25. Which one I will take? Then I will take the higher of the two, the longer period. Or suppose reverse. If as per normal operating cycle, it should be realized on 30th June 24. But 12 months from the reporting date is 31st March 25. So if it is realized even by 31st March 25, then in that case it will be current. So other receivables are covered under this category. And one last one, it is cash or cash equivalent. Cash and cash equivalent are always treated as current. But there is a condition here also, unless it is restricted from being exchanged or used to settle liability for at least 12 months after the reporting period. But suppose you have cash or cash equivalent and you cannot use it for 12 months, there is a restriction on using it, then it is not a current asset. Possibility is there, like for example, government freezes bank account. It happens if a company does some mischief, default, the government will instruct the banks to freeze their account, and you cannot withdraw money, transfer money, use that money for let's say 12 months. So then that bank account will be treated as non-current. Sometime in order to get a government contract, we may have to deposit some tender money. and that you cannot withdraw for 12 months. So that portion will become non-current. Or suppose you have FD also, bank FD, but that bank FD cannot be withdrawn. Normally we can withdraw, but suppose we can't withdraw for 12 months, then even that bank FD will become non-current, because then it is not liquid. The idea is to test the liquidity. So if the asset cannot be liquidated within 12 months or operating cycle, then you can't put it as current asset. Otherwise you are misguiding the user that this company has liquidity, but actually you are not able to use that funds. Understood the logic? For the purpose of classification, each asset at the reporting date has to be assessed. So on the reporting date we have to see what is the status. Is it current or non-current on the basis of the relevant criteria as mentioned above. What is the definition of non-current asset? An asset which is not a current asset is non-current asset. So we have to test current asset by applying any of the 4 criteria. Some example I have written: balance sheet item inventory receivable. Usually they will be treated as current. Okay, because they are realized, sold or consumed in the normal operating cycle. Then loan recoverable on demand. Loan recoverable on demand. What is loan recoverable on demand? You can simply ask the other party to repay the loan. So expectation of the entity we have to check. If the expectation of the entity is that it will be realized within 12 months, then it will be current. But if the expectation is it will not be realized, non-current. For example, this question will come in one of the questions. Parent company has given loan to subsidiary, and this is a loan recoverable on demand, but parent company is not going to ask for repayment. For the namesake they have called it recoverable on demand, but they know that parent is not going to ask the repayment. Then where will this loan given to subsidiary appear? Non-current, because there is no expectation of realization within 12 months. If there is expectation of realization within 12 months, then current. So expectation is a very subjective term. So management has to really check whether they expect to realize it or not. Now what about securities? Suppose in the question you are given investment in shares. Again here in such item one has to see the expectation. Is the management intending to realize it within 12 months or not? If the answer is yes, you put it under current. So intention of the entity as to whether held for trading or not. If not, the expectation of the entity to realize within the 12 months period after the reporting date we have to check. If it is held for trading, condition 2 will get satisfied. Second condition for current asset is those assets which are primarily held for the purpose of trading. But suppose it is not held for trading, then you have to see the expectation. Is the management expecting to realize it within 12 months? If the answer is yes, then it is current. If the expectation is no, not current. Some notes I have written for you. Inventory receivables are generally current. Generally current. Underline the word generally, but not necessarily, because these are held within the normal operating cycle. But there can be debtors who may be given extended credit period, additional credit. Okay, then that particular debtor will be put in non-current. Financial asset held for trade can be investment for sale. So this will be current. For other assets, apply the test of realization within 12 months. So one question will come, very good question from your ICI material. where you have to answer whether this will be current or not. An entity has placed certain deposits with various parties. So you have deposited amount. How the following deposit will be classified, current or non-current? Interesting question. Electricity deposit. When you take electricity connection, you have to give electricity deposit. Although you can surrender and recover your amount anytime, but what is your expectation? Are you going to surrender and recover the amount within 12 months? The answer is no. Even though you can, but the expectation is I am not going to do that. So usually these items will be non-current because you are not going to realize that amount. You don't expect to realize that amount within 12 months. What about this tender deposit, earnest money deposit, EMD? Now here we cannot give one answer because it will vary from tender to tender, terms and conditions are given. So here you will write both the answers. If it is expected to be realized within 12 months, depending upon the terms of the tender, then current. But if it is not expected to be realized, then non-current. What about this GST deposit paid under dispute or GST payment under dispute? Now you are dealing with Indian government on the other side here. Not easy. Two answers are possible here because this is a very limited information. One line, I can't use this one line to make a concluding remark. So I will say if the amount is expected to be realized within 12 months, because you will have history of similar transaction in the past also. Now GST law has been introduced long back. So we know in how many months or years you get the amount back. So based on your expectation, you do the classification here. It can be current or it can be non-current. Just quickly read the answer yourself. If you have doubt in any line or point, please tell me. I will ask you to read the answer yourself. This is how professional answers are drafted. If it is MCQ question, then it is okay. But if it is a 4-mark question, then write like this. So I'll give you 30 seconds to read. Read yourself. At the same time, keep thinking also. Read the answer, please. Do they ask such questions in the exam? Yes, sometimes. Okay. So read the third answer now. Read the third answer, Rahul. Read third answer, Hari. So here also for the last two answers, your answer will be depends on the expectation of realization. Okay, can we go to question number 14 below? Taken from again study material, an entity produces whiskey from barley, water and yeast in a 24-month distillation process. At the end of the reporting period, the entity has 1 month supply of barley and yeast raw material, 800 barrels of partly distilled whiskey and 200 barrels of distilled whiskey. Classify as current or non-current. Yes, what will be your answer?
Current.
What is the operating cycle here? 24 months. And normally this will be sold or consumed within the normal operating cycle period. So therefore they will be treated as current. Usually inventory item you will treat it as current. So the answer is all raw material barley and yeast, work in progress which is partly distilled whiskey, and finished goods which is distilled whiskey are inventories. The raw material are expected to be realized in the entity's normal operating cycle. Therefore, even though the realization is expected to take place more than 12 months after the end of the reporting period, this raw material, WIP and finished goods will be treated as current. If normal operating cycle itself is 24 months, then take that as a cutoff for identifying current or non-current. Question number 15. An entity owns a machine with which it manufactures goods for sale. It also owns the building in which it carries out its commercial activities. Classify machine and building as current or non-current? Non-current only, unless they are held for sale. There is one standard called Ind AS 105, non-current asset held for sale. If non-current asset is held for sale, then they are put under current asset. But if non-current asset are for use in the business, which is very clear in the problem, then they will always be non-current. So these are non-current asset. And then you will have to say why they are non-current asset, because they do not fulfill any of the requirement of current asset. They are not cash on cash equivalent. They are not expected to be realized or consumed or sold in the normal operating cycle. They are not for the purpose of trading, and they are not expected to be realized within 12 months from the end of the reporting period. Question number 16. Question number 16. On 31st December 20x2, an entity replaced a machine in its production line. The replaced machine was sold to a competitor for rupees 3 lakh. Payment is due 15 months after the end of the reporting period. Now you have sold the machine and payment is due, means the machine is not relevant now. Amount receivable from the party is appearing in your book. Debtor for machine is appearing in the book, and you are going to recover after 15 months, whether it is current or non-current. If nothing is given about operating cycle period, then we will take 12 months as cut-off date, and the answer will be non-current asset.
Operating cycle condition should not be applied.
Yes, operating cycle condition is not required to be applied here, because it is the receivable for sale of machine. So 12 months from the end of the reporting period criteria, and that is not satisfied. Okay. If the payment was due in less than 12 months, is the answer printed in the book?
Yes, sir.
Then I don't have to dictate. From the end of the reporting period, then it would be classified as current asset. So for other receivable, take the 12 months cutoff. Now I am going to solve one numerical question in the book. You can solve in the notebook if you don't have the hard copy of the notes. Right? This question will be discussed in Ind AS 109 also. On 1st April 2022, XYZ has invested rupees 15 lakh surplus fund in corporate bond that will pay interest at 8% per year. Interest is payable on corporate bond on 1st April of each year. So 1st April 23, interest will be paid on 15 lakh. How much interest will be paid? 8% of 15 lakh. 1,20,000. Very good. Interest is payable on corporate bond on 1st April. The principal is payable in 3 annual installment of 5 lakh. Plus you are also going to pay 5 lakh here, first installment on 1st April. And then you will go to 1st April 24, again you will pay interest and principal. principal is 5 lakh, interest will change because out of 15 lakh 5 lakh has been paid. So 10 lakh into 8%, 80,000, and then 1,425, you will pay 40,000 interest and principal 5 lakh. Suppose you are preparing the financial statement here on 31st March 23. Just understand. So on 31st March 23, in my balance sheet, the total amount recoverable will be how much? 15 lakh plus interest accrued for 1 year. Payment will be received on 1st April, but on 31st March, that accrued figure will appear 16 lakh 20,000. Out of that 16 lakh 20,000, 1 lakh 20,000 plus 5 lakh will be shown as current because that will be recovered within 12 months from the reporting date, and remaining amount will be treated as non-current. Same goes here also, and same goes here also. Understood? So you will have to divide the amount recoverable into two parts every year, non-current portion and current portion. Accordingly, liquidity will be understood by the users. So right, I will first explain with the help of timeline. There are 4 dates in the problem. Write down 1/4/22. What happened? You made an investment in bond. Right? Those who have the book will write inside the book. Those who don't have the book will write in the notebook. Investment in bond 8%, rupees 15 lakh. Then on 1/4/23, you recovered interest. You can put the interest amount if you have understood 1,20,000, 8% of 15 lakh. Interest in bracket 1,20,000 plus installment in bracket 5 lakh. Then on 1/4/24, you will recover interest 80,000 plus installment rupees 5 lakh plus installment rupees 5 lakh. And then on 1/4/25, you will recover interest 40,000 and installment rupees 5 lakh and installment rupees 5 lakh. Do you agree? Say yes. Yes. Now, although it is not required, but I will make your understanding more clear by preparing investment in 8% bond account, so that you will see what is the balance outstanding here every year and how this balance outstanding will be divided into non-current and current portion. So like your 12th standard accounts class, draw the investment in 8% bond account. Draw the investment in 8% bond account. Then on 1st April 2022, first you will purchase the bond. Entry, investment to bank 15 lakh. 31st March 23, what will happen? Interest will accrue. So to interest 8% of 15 lakh, 120. And then you will write 31st March 23 by balance carried down, because the amount will be received on 1st April. On 31st March, we are going to show 16,20,000. So this is my balance, and we have to present in the balance sheet some portion in current and some portion in non-current. Okay, that is the test. Good question. Write down, important for 4 marks. to balance brought down, they can ask you to prepare ledger also. So opening balance, write down 1423, 16,20,000. Then first thing you do on the credit side, buy bank. Buy bank. $6,20,000. Then again we'll write down to interest. Interest will accrue on remaining 10 lakh rupees at 8%. Yes or no?
Yes.
Very good. 31st March 24 buy balance carried down. Come on student. 10,80,000, total 17 lakh. Now on 1/4/24, to balance brought down 10,80,000, and buy bank, how much will you pay? 5 lakh principal, 80,000 interest, and debit side 31st March 25 to interest 5 lakh into 8%. Show the calculation also. 40,000. Buy balance carried down 540. Total 1120. 1/4/25 last year. To balance brought down. Very easy. Come on. 5,40,000. Buy bank 5,40,000. So basically, if you see, these are my balances, and you have to present in such a manner that out of that, whatever is going to be realized within 12 months will come in current. So out of this 16,20,000, you can see 620 got realized in 12 months. So this will go in current, and remaining 10 lakh will be non-current. Out of this 1080, 580 got realized in the next 12 months. So 580 will be current and 5 lakh will be non-current. And out of this 540, everything you recovered in the next year only, within 12 months. So entire amount in the last year will be treated as current asset. Okay. Write down below balance sheet extract. Balance sheet extract, write down 3 columns on the right side: 31st March 23, 31st March 24, 31st March 25. Non-current asset. It is only an extract for understanding. First you write non-current asset, under that financial asset, under that investment. As per our discussion, how much will be non-current? 10 lakh. Second year 5 lakh. Third year 0. And first year current asset, write financial asset, investment. Investment will be 5 lakh, and interest accrued on investment 1,20,000. Interest accrued on investment is right. Next year 5 lakh. Financial asset 5 lakh. Interest accrued 80,000. Last year non-current 0. Financial asset, investment 5 lakh, and interest accrued 40,000. Because if you have so much cash flow coming in within 12 months, it will improve your current ratio. Is it right? So good for the company. So there is a note printed there which is given by the institute in its balance sheet on 31st March 23. I have given in the form of balance sheet, institute had given in the form of a paragraph. The entity must present 1,20,000 accrued interest and rupees 5 lakh current portion of the non-current loan, that is portion repayable on 31st March 23 as current asset, because they are expected to be realized within 12 months. And second note, installment of 10 lakh due later than 12 months after the end of the reporting period is presented as a non-current asset because it is not cash or cash equivalent, as it is not expected to be realized or consumed in the entity's normal operating cycle. It is not held for the purpose of trading, and it is not expected to be realized within 12 months of the end of the reporting period. That way they draft the answer nicely. One more question, number 18. X Limited has the following investment on 31st March 22. How should the company classify this investment into current and non-current for the purpose of Ind AS 1? So you will write the answer below in the solution table provided. There are 5 investment. This way they will ask question in the exam for 5 marks, 6 marks. Okay. Investment in equity, shares and bond classified as financial asset at FVTPL. Classified as financial asset at FVTPL. Rupees 10 lakh. So where will you show it? Current or non-current? Just because it is FVTPL does not mean always 100% current. Is it right? It means the change in fair value will go through P&L account. So therefore it will depend on expectation. Okay. So write down the first answer. It has 2 answers. Equity share can be classified as FVTPL, but the expectation to realize it may not be within 12 months. More about that, actually this question is from Ind AS 109. If you will understand Ind AS 109, then this answer will be little easier. But the thing is that I can't teach 109 to start with. Okay. Before you learn the story of Shakespeare, first learn ABC. Ind AS 109 is Shakespeare's story. Ind AS 1 is ABC. So answer is current asset if these are, just write down, if expected to realize within 12 months if you don't have space, and non-current asset if not expected to be realized within 12 months. If not expected to be realized within 12 months. Done. The second question is investment in equity, shares and bond classified as financial asset as at FVT OCI. If it is FVT OCI, then also we'll have same answer. Depends on expectation. So same answer you copy again for the second part also. Write down same as above. Current, non-current, same as above. Same as above. Then what about investment in subsidiary 50 lakh? So normally investment in subsidiary, associates and joint venture are treated as non-current because the objective is to make this investment for long-term business purpose. But if specifically it is given that these investments are meant for held for sale, these investments are meant for held for sale, then they will be called as current. Then they will be called as current. Otherwise, by default, subsidiary, associate, joint ventures are long-term investment. Their objective is to run the business, earn from the profit of the business, not from the trading in that investment. So usually If no condition is given, then non-current asset. And then you can write down, unless the subsidiary is held for sale. Unless the subsidiary is held for sale. Classified as non-current unless the subsidiary is held for sale. And there is a fifth item below where some note is going to come. You can write, if you want, refer to item 5 below. Refer to item 5 below. Next is investment in associate. Same answer. You can, if you don't have space, write same as above. Non-current asset, reason same as above. And the last item is investment in subsidiary, which is planned to be sold during 22-23. So if the investment is held for sale, which is clearly mentioned, and the expected realization period is within 12 months also, next year. So you will say current asset. You will say current asset. And if you want to write the reason, the investment is expected to be realized. The investment is expected to be realized within 12 months. Within 12 months as per Ind AS 105. Within 12 months as per Ind AS 105. This is presented separately. This is presented separately as per Ind AS 105. Ind AS 105 is called non-current asset held for sale. So usually it is a non-current asset, but held for sale means you want to sell it within 12 months. So the classification changes from non-current to current, because the purpose of holding that investment has changed. So after a long discussion on current asset, most of the questions were from institute material. Few questions I have added from reference books also to fill that gap which is there in the study material. Okay, like this question 18 was, I think, from a reference book. Now come to current liabilities. Here also the balance sheet will be divided into current and non-current liabilities. Current liabilities are payable in short period of time. That is what we know in general. But for the purpose of standard, for the purpose of exam, there is a specific definition of current liability, similar to definition of current asset. There are 4 conditions. Any of the 4 conditions, if satisfied, it is a current liability. But if all 4 conditions are not satisfied, then it is a non-current liability, and companies have to really put it properly, because it will affect their current ratio, liquid ratio, acid test ratio. Is it right? Lot of ratios get affected, and if the current ratio, because of putting lot of item in current liability, goes down, then some bankers, they will not give you further funding, because generally the bankers also have a target that we will give loan to companies whose current ratio is above 2.5, above 2, and if because of current liabilities that ratio falls below 2, they may not give you the loan. Some investors don't invest in companies with low liquidity ratio, because if there is a liquidity problem, company will default. Like some airline companies have defaulted and now they are grounded. Instead of flying, they are on ground now. So what is a current liability? It is expected to be settled in the normal operating cycle. Definition of current asset was expected to be realized, sold or consumed. But liability is not realized, liability is settled in the normal operating cycle. So what will come here? All your trade payable and other operating payable will usually come under current liability. usually, but sometimes suppose a trade payable gives you 5-year credit, maybe, then that is not current. But if nothing is given, trade payable, usual operating expenses payable, they will come under current liability. Second, held primarily for trading. Example, derivatives. Derivatives are held for trading. Option, future can be derivative liability. We will see in Ind AS 109, they appear as derivative liability in the balance sheet. And nowadays students know more than teacher about derivatives. They are deep neck in future and option. Some of them have sunk also. Yes, yes. Next, for other liabilities you will check this condition: due to be settled within 12 months after the end of the reporting period for other payables. And the next is important point on which we have some questions coming soon. It cannot be unconditionally deferred for at least 12 months after the reporting period. It cannot be unconditionally deferred for a period of 12 months. Like some minutes before I had taken one example, loan payable on demand. Very interesting example. There are two parties. One is parent company which has given loan to subsidiary, and subsidiary company which has taken loan from the parent. So in parent's book it is an asset. In subsidiary book it is a liability. What was the answer we had discussed here? It depends on expectation. It depends on expectation. What will be the answer in case of subsidiary? Always current liability, because it is loan payable on demand. So whenever the parent will demand, the subsidiary will have to pay. It cannot unconditionally defer. It cannot unconditionally postpone it for a period of more than 12 months. Here expectation will not matter. From the point of view of liability, expectation will not matter. Is it right? If you are looking at from liability angle, then expectation will not matter. Then you have to see, can I unconditionally defer it for more than 12 months? Suppose you have taken a loan from bank. The loan from bank says in one of the loan clauses, company can extend the maturity. Company has unconditional right to extend maturity beyond 12 months. That question will come again, don't worry. It is there. So first you focus on this example. You have taken a loan from the bank. Loan agreement says company has unconditional right to extend loan beyond 12 months. Then it is a non-current liability, because then the company has got unconditional right to defer it beyond 12 months. But if the problem says company does not have right to defer the loan, then you have to see all other conditions also. Suppose you have issued convertible debenture. Convertible debenture holders are given an option to convert into share. And now the date of conversion is within 12 months from the reporting date. Today is 31st March 24. Conversion date is suppose 1st January 25. Now there are two possibilities. They may convert, they may not convert. But if they if they don't convert, you have an unconditional, you don't have unconditional right to defer the payment. You have to pay if he wants. So simple test is, if the other party suppose wants and you have no choice but to pay, you cannot on your own defer the payment, then such liability will become current liabilities. Expectations are immaterial here. Expectations are immaterial, but expectations are material in case of current asset. So the standard is more strict as far as current liabilities are concerned, where you don't have to look at expectation, you have to see whether you can unconditionally defer it or not. Is it right? So now we'll come to next one. All other assets and liabilities are classified as non-current. So what is non-current liability? If it does not fit into any of the four conditions mentioned above, then it will go to non-current liability, right? Very important, because this will affect current ratio, liquid ratio, absolute cash ratio, some ratio you have studied in that ratio analysis topic. Now let us test our understanding. Question number 19. Gas agency requires an amount to be deposited as security deposit, which is refundable when the gas connection is surrendered. So there are two parties here. One is the customer and one is this gas agency. You have deposited some security deposit. You have to pay some amount to take that gas connection, okay, like that electricity deposit example. For customer, it answer can be both current and non-current, because he may not opt for disconnection, even though theoretically he can submit the connection and get his money back, but usually he will not. So usually in his case the answer will be non-current, but of course it can be current also. If you are suppose a hostelite and you want to stay in Pune for only 1 year, you can take a temporary connection for 1 year. But what about gas agency? Any day the customer surrenders the gas connection, they have no choice to defer the payment. There is no unconditional right to defer the payment. So here the answer would be, for the gas agency, always current. For the customer, current or non-current. Is the answer printed? No. Please write down question number 19 answer. In the notebook write down. Question is from study metal, I think. Although it is expected that there is no point in arguing that customers will not come and ask for deposit. Do you have unconditional right to defer the payment? No. Matter closed. It is a current liability. We have to be little prudent here. Although it is expected that most of the customers will not surrender their connection and the deposit will not be refunded, comma, but surrendering of gas connection by the customer is a condition, that is not within the control of the entity. Right? So what is the conclusion? Write down conclusion. Hence, the gas agency Hence the gas agency does not have an unconditional right to defer payment of the liability for at least 12 months after the reporting period. Accordingly, deposit will have to be classified as current liability. This way you have to write the answer. Only writing current liability will not be enough if it is a 4-mark question. Okay, one more easy question this time. X Limited has unclaimed dividend of 20 lakh on 31st March 2022. Classify unclaimed dividend into current and non-current liabilities. So where will you put unclaimed dividend? Why current liability? Because suppose the shareholder raises the claim, then you can't say no, you can't come now. They have got, I think, 7 years to claim that amount, and any day if he files a claim form, then company will have to make the pay. He cannot unconditionally defer it for 12 months or more. So always current. In schedule 3 problems also it had come. Unclaimed dividend is classified as an item of current liability. Unclaimed dividend is classified as an item of current liability since it is payable on demand. I am not writing much. You can extend the answer yourself. Company does not have unconditional right to defer the payment more than 12 months from the reporting date, etc. Depending upon the marks allotted, you will stretch the answer. Okay. Now come to question number 21. X Limited has created provision for tax for the year 21-22 amounting to rupees 10 lakh and advance tax of rupees 9 lakh. When do you create provision for tax? You create provision for tax for the current year, because you know it is payable within 12 months. And then you also create advance tax, because that advance tax is to pay that final tax liability. So classify the provision into current and non-current. So current liability, because it is going to be settled within 12 months from the reporting date. So the answer would be easy. Provision for tax. Write nicely in the notebook. One day you have to read also. If you don't have to read, then it's okay. I hope you have not come here only for getting knowledge. You have to also appear for the exam, where you have to present the answer in a professional manner. Some writing practice I am doing purposefully. I could have given the answer in print also, but then some answer we will write. Most answer I will give you in typing. Write provision for tax net of advance tax is reversed when the assessment is over and the entity gets confirmation that there is no additional liability. Entity gets confirmation that there is no additional liability. Next line, since the assessment is expected to be carried out by the tax authority, during the assessment year, which falls within 12 months after the reporting period, the tax provision is classified as current liability. Have you noted the answer?
Yes.
Are you satisfied with the answer?
Yes.
Okay. Then come to question number 22. Question is from study material, similar to the one we had solved, investment in bond. Do you remember? But that time it was current asset, non-current asset. Same question from the issuing company's point of view now. On 1st April 2003, Charming Limited, is it the problem? First two line you delete, that has come by mistake. Okay. The question starts from 1st April 2003. Charming Limited issued rupees 1 lakh rupees 10 bond for rupees 10 lakh rupees. What is the total face value of the bond? 10 lakh. Number of bonds 1 lakh. Per bond face value is 10 rupees. On 1st April each year, interest at the fixed rate of 8% per year is payable on outstanding capital amount of the bond. That is, the first payment will be made on 1st April 2004. Similar problem. Is it right? On 1st April each year, that is from 1st April 2004, Charming Limited has a contractual obligation to redeem 10,000 bonds of rupees 10. 10,000 bonds of rupees 10 means 1 lakh rupees per bond, at rupees 10 per bond, in its statement of financial position on 31st March 2004. Only on 1 year they have asked. How should this be presented in the financial statement? So, how much will be current liability and how much will be non-current liability?
1 lakh plus 8%.
Total amount will appear in the balance sheet 10 lakh rupees plus interest 80,000. 10 lakh total liability. Current will be 1 lakh principal which you have to pay plus this interest which has accrued, and non-current portion will be 9 lakh. 1 lakh 80,000 will appear in current financial liability, under that bond and interest accrued, and non-current will appear under financial liability 9 lakh. Same problem we have done from investor's angle. So I am not preparing ledger. If they ask you, will you be able to prepare? Will you be able to prepare the ledger? Say yes. Yes. So just few lines I will give you, already printed in the book. Charming Limited must present 80,000 accrued interest and rupees 1 lakh current portion of the non-current bond, that is the portion repayable on 1st April 2004 as current liability, and rupees 9 lakh which will fall due later than 12 months after the end of the reporting period will be presented as a non-current liability. So simple question. Now this was about current and non-current liability. Now the next thing is, what is normal operating cycle? Because the definition of current asset and current liability includes normal operating cycle. So normal operating cycle, if the student will remember, in FM there was a topic working capital management, and there the question was calculate the normal or just operating cycle. So normal or operating cycle means it comprises of acquisition of asset for processing to their realization in cash or cash equivalent. In FM we say time required to convert cash into raw material into WIP, WIP into finished goods into debtors, and then collection from debtor. We do not consider, what we don't consider? Creditors payment period. We only consider raw material storage period, WIP holding period, finished goods holding period, and debtors collection period, or any current asset which is processed here, that will be considered. The time required for payment of current liability item will not be considered. Depending upon the business model, the current asset can be shorter or longer than 12 months. Like for example, if it is a construction business, it can be 3 years, 2 years. If it is a shipbuilding, huge ship, they take 4 or 5 years to manufacture a ship that has capacity of some thousands of tons. Is it right? Or for example, liquor, wine, they may take 3 years, 5 years before they are finally ready for sale. But generally it may be less than 12 months also. So the standard says, if you can't identify operating cycle clearly, then you can assume 12 months. Okay. Next is, for students' queries, this line was added by me. What about creditor payment period? Because in FM they also introduce creditor payment period. Will not consider that, because it may happen creditor payment period is more than the total of other items, and it might be negative also. Can it be negative? Yes or no? Yes, there can be negative. You don't keep the finished good stock, you don't give credit to the debtor, but you take 12 months credit from the supplier. So no credit period, payment period will be considered. And next is, as you have studied in FM, we will take on an average what is the stock holding period, on an average what is your debtors collection period, because every debtor will have a different collection period. So what we do, we take average holding period, generally how much you take. So therefore current asset and current liability will be identified on the basis of normal operating cycle. One more thing they have clarified, if the entity has multiple businesses having different operating cycles, then business wise you have to identify assets and liabilities, and accordingly you will classify assets and liabilities as current or non-current. And you see, there is a question also in the study material. This was in March 2022 MTP, and similar question is there in the study material also. So tick mark this question for exam purpose. They have asked in MTP. Entity A has two different businesses, real estate and manufacture of passenger vehicles. With respect to the real estate business, the entity construct residential apartment for customer, and the normal operating cycle is 3 to 4 years. And with respect to the business of manufacture of passenger vehicle, the normal operating cycle is 15 months. So you understood what they are going to ask. Under such circumstances where an entity has different operating cycle for different types of businesses, how classification into current and non-current be made? So the answer is, for the real estate, normal operating cycle is 3 to 4 years. So the assets and liabilities of real estate business will be classified taking normal operating cycle as 3 to 4 years, and the assets and liabilities of passenger vehicle will be classified into current or non-current by using operating cycle of 15 months. Is the answer given in your book?
No.
Okay, write down. Just this much I have edited the answer. In the exam you can explain what is normal operating cycle, what is current asset, current liabilities, depending upon time availability. Okay, you can stretch the answer by explaining some terms, but main answer should be there. This is the main answer. When businesses have different operating cycles, when businesses have different operating cycles, when businesses have different operating cycles, classification of asset or liability, classification of asset or liability as current or non-current, as current or non-current would be in relation to would be in relation to normal operating cycle, would be in relation to normal operating cycle that is relevant to that particular asset or liability, that is relevant to that particular asset or liability. Okay, this is the main answer. And you can also add, it is advisable to disclose, the normal operating cycle, it is advisable to disclose the normal operating cycle to different types of businesses, for better understanding. Different types of businesses for better understanding. So companies where you have multiple operating cycle for different businesses will disclose what is the operating cycle for separate business. Question number 24. B Limited produces aircrafts. The source is March 22 MTP. This was 2 marks. The length of the time between first purchasing raw material to make the aircraft and the date the company completes the production and delivery is 9 months. The company receives the payment for the aircraft 7 months after the delivery. So 9 months is production, purchase of raw material and production, and 7 months is collection from debtor. So can you please guess what is the normal operating cycle period? 16 months. So first answer is 16 months, and second answer, how should it treat its inventory and debtor? This inventory and debtor would be realized or sold in the normal or consumed in the normal operating cycle only. So therefore both will be treated as current asset. Write down the answer nicely. First write down point A, answer of A, the length of the operating cycle will be 16 months. The length of the operating cycle will be 16 months. B, write down, assuming that inventory and debtors, assuming that inventory and debtors will be realized within normal operating cycle, that is 16 months, both the inventory as well as debtors, should be classified as current. Is it right? Now next question, very easy, taken from some of the institute publication only. They should not ask such question to intelligent people. X Limited provides you the following information: raw material stock holding period 3 months, WIP holding period 1 month, finished goods holding period 5 months, debtor collection period 5 months. So can you add them?
Yes.
You are requested to compute the operating cycle of X Limited. How much is that? 14 months. Already I have given the answer. But the same question continues, and now it says, because they will come as one question in the exam, in the above illustration, what would happen if the trade payable of the company are paid in 12.5 months? Would it be classified as current or non-current? So now don't look at 12.5, look at the normal operating cycle, which is higher than 12.5 months. So the definition of current liability says if it is expected to be settled within normal operating cycle period. So the answer is, because it is going to be settled within normal operating cycle period, it will be treated as current. Write down the answer. Answer of question 26. Since the operating cycle of X Limited is 14 months, trade payable expected to be settled in 12.5 months should be classified as current liability. Trade payable expected to be settled within 12.5 months should be classified as current liability. Okay. This way you can write the answer. One next question, 27. This time the answer is already printed. Only concentrate on understanding. Paragraph 69A of Ind AS 1 states, an entity shall classify a liability as current when it expects to settle the liability in the normal operating cycle. An entity develops tools for customers, and this normally takes a period of around 2 years of completion. So 2 years is given. The material is supplied by the customer and the entity only renders a service. For this, the entity receives payment upfront and credits the amount so received to income received in advance. So customer makes advance payment. Unless and until you deliver the product after completing the necessary service, you show that amount received under the heading income received in advance. Bank account debit to income received in advance, and this income received in advance becomes your liability. How should this income received in advance be classified? Current or non-current? Now in this case the normal operating cycle will be 2 years. So therefore, it will be treated as current liability. See the answer. No need to write the answer. This answer is already printed. Ind AS 1 provides some current liabilities such as trade payable and some accrual for employee and other operating costs are part of working capital used in the entity's normal operating cycle. So this is a part of working capital, and if it is a part of your working capital, you have to check the normal operating cycle. An entity classifies such operating item as current if they are due to be settled more than 12 months after the reporting date. In accordance with the above, income received in advance would be classified as current liability since it is a part of working capital which the entity expects to earn within its normal operating cycle. Good question. One more question, number 28. An entity manufactures passenger vehicle. This is also from your institute publication only. The time between purchasing of underlying raw material to manufacture the passenger vehicle and the date the entity completed the production and delivery is 11 months. Customer settle the dues after 8 months. So 11 plus 8, 19 months. A. Will the inventory and trade receivable be current in nature? I think we have done a similar problem. That was question number 23, I think. Not 23. 24. Yes, 24. It is just similar to that, 24 number. Assume that the production time will say 15 months and the time lag, only this question they have added, hence I am taking it. First part is same as question number 22. Assume that the production time was say 15 months. Is it there? And the time lag between sale and collection is 13 months. Will the answer be different? No, your operating cycle will be 28 months now. And if the inventory and debtors are expected to be realized within the normal operating cycle period, they will still be treated as current liabilities. They will still be treated as current. So first answer is current and second answer is also current. Okay, so it's written there, answer will be the same. Inventory and debtor both will be classified as current. So they are just testing your confidence. Some student will think first answer is current, so this answer I will write non-current. It's not like that. Every question you have to assess independently. So this was a discussion on current asset, current liabilities, operating cycle. Sometimes they ask such questions in the exam. But the question which is heavily tested from this topic, heavily tested, including in May 2023 exam, there was a question on loan, classification of loan into current and non-current. Is it right? So first we will take a break, 5 minutes, because that is a long discussion, an important discussion. So you have to be fresh, mind should be calm, quiet. Okay.
स्ट्रॉबेरी खा लिया लास्ट टाइम क्लास
Okay, can we start now?
Yes.
So we are going to discuss something very important, and on this paragraph usually the questions are asked on this topic. So you tick mark one question number 49 in your book, which was asked in May 2023 exam for 5 marks, and it is from this paragraph. You will be able to solve after we discuss it. Ready?
Yes.
Question before that, come to loan. So what is the topic? Companies take loan. Whether this loan will be classified as current or non-current, that is the issue. So what is the big issue about it? If it is treated as current, then your ratio is current ratio is equal to current asset upon current liabilities. If you increase the value of current liability, what happens to the ratio? Ratio will fall. Ratio will fall if the current liability in the ratio goes up, and if the current ratio falls, it shows a poor liquidity position. That means if liquidity position is 2 or 1.2, this is from the investor's point of view, from the lender's point of view, from the parties who have to take money from this company, they would prefer company with 2 liquidity ratio, 2 current ratio than 1.2. Now some companies will play here. What is the play here? The liability may be current, but they would like to put it under non-current so that their current ratio improves. Okay, and if current ratio improves, their chances of raising funds will also improve. But the standard gives you lot of situation and how to classify liability as current or non-current. Like for example, sometime loan is payable on demand. Sometime the company has unconditional right to extend the period of the loan. Company may not have unconditional right to extend the period of the loan. Company may have committed breach of the loan contract. The breach can be minor breach or major breach. Sometimes the company breaches the contract, but the bank gives a grace period to rectify that. Grace period can be more than 12 months, less than 12 months. Breach can be rectified before the financial statements are approved, or after the financial statement are approved, or before the year ending date itself. So multiple situation can arise which will have different answer. Okay, and here there is one carve out also, that is a major difference between Ind AS and its counterpart IAS 1. Because of Indian situation, they have made a carve out also here. That carve out also we will see, and why that carve out was made. So are you ready?
Yes, sir.
So I have divided this total situation into 9 points just for understanding, and if you can identify from the question where do you stand, you can write the answer. So we'll do some practice also. So some time we will invest here, because from exam point of view this is really important. First is loan liability, case 1, situation number 1, payable on demand. Payable on demand means from the borrower's point of view, always current liability. From lender's point of view, you can check the expectation. From the lender's point of view, they can show current or non-current asset, but the borrower does not have unconditional right to defer the payment beyond 12 months. It is repayable on demand. So always current liability. Do not see the intention here. If it is payable on demand, you have to put it as current liability. Situation number 2A, loan extension, also called rollover. Now here situation A is under 2A, entity does not have discretion. Entity does not have discretion. Entity does not have discretion means entity does not have unconditional right to extend the period of the loan. Then situation number 1, loan is payable within 12 months from the reporting date and the entity obtains extension to pay beyond 12 months. Entity obtains extension to pay beyond 12 months. But when was extension received? This extension is received before the balance sheet date. So once the extension is received before the balance sheet date, it means this becomes operative, this becomes effective, and check the number of months after which you are going to pay the loan after the extension. If it is beyond 12 months, then it is a non-current liability. Extension received before the balance sheet date for a period of more than 12 months. And situation number 2, loan is payable within 12 months from the reporting date and extension is received, underline, after balance sheet date but before the approval of the financial statement. Now this is confusing. Extension received after balance sheet date but before the approval of the financial statement by the board. So the standard says look at the condition on the balance sheet date. On the balance sheet date, what is the condition? Current liability, because it became payable within 12 months. So as on the balance sheet date, the condition of the loan is current liability. New situation have arisen after the balance sheet date. New situation has arisen after the balance sheet date. So check the condition on the balance sheet date, and on the balance sheet date, if the loan is payable within 12 months, we will call it current liabilities. 2B is very easy. You can easily answer. Loan extension. Entity has the discretion. Entity has the discretion to roll over for a period of more than 12 months from the reporting date. So who has the discretion? That means if the entity wants, it can extend the maturity beyond 12 months from the balance sheet date. So it has got the right to extend beyond 12 months, non-current liability. Then third point, loan is payable within 12 months from the reporting date. Loan is payable within 12 months and the entity obtained refinance from other bank or another facility either before the balance sheet date or after the end of the reporting period but before the statement is approved for issue. Loan is payable within 12 months and you have obtained refinance from another bank or another facility. So what will happen to this loan? This will be current liability. If you have taken a loan from SBI which is payable in 12 months, then you get it refinanced from ICICI Bank. So as far as this loan of SBI is concerned, that will appear as a current liability and the new loan will be classified current or non-current depending upon the occurrence and period. So what is the period of that loan, terms and condition of that loan? Based on that, new loan will be classified, but this existing loan will appear as current liability. This is very important. Point number 4, write down important, because we have a carve out here, breach of loan condition. Sir, what is the meaning of breach of loan condition? Breaking of the terms and condition of the loan contract. Loan comes with lot of terms and condition, covenants. Technically they are called covenants, terms and condition. Like company will submit stock report every month, company will submit debtor statement every month, company will submit quarterly profit and loss balance sheet every month. Promoters will bring so much capital within so many days. Is it right? And like that. Some of these breaches can be minor, like for example not submitting a stock statement. Okay, it may be delayed by few days. So normally those are ignored. Breach of minor, but if breach is major, promoters have to also bring equivalent amount in capital. That was the condition of granting loan. Promoters did not bring their capital. So this is a major breach. Now what to do? So we'll read the situation and then the treatment. Breach makes suppose loan repayable on demand. So loan has become repayable on demand, but wait, that does not mean it will be current. And second thing is that breach should exist on the balance sheet date. Breach should make the loan repayable on demand. Breach should exist on the balance sheet date. If suppose there was a breach before the balance sheet date and it got rectified also before the balance sheet date, then we have to see what is the situation after rectification, because that breach did not exist on the balance sheet date. Example, if the condition is breached in January but not rectified till March 31st, which means breach is existing on the balance sheet date, and then we will discuss further. If there is a probable breach, it is not relevant. Probable breach is not relevant. Company thinks that it might default on certain condition, but that might default is not relevant. Probable breach is not relevant. Similarly, breach already rectified before balance sheet is not relevant. Breach took place, suppose in the previous example in January. You go to the bank, you rectify the defect, whatever default, whatever was there, and then matter is resolved before balance sheet date. So point number one, breach should exist on the balance sheet date. Breach should make the loan repayable on demand. Okay. Then you see what is the type of breach. Minor breach, ignore, because for every small non-compliance I can't apply this standard. Sometimes they just have to submit some stock certificate signed by a CA, which normally they delay, and bank also does not bother, because bank can't lose a customer for such minor defaults. Okay, understand? They are businessmen, they have to maintain relation with the customer. So minor breaches are ignored, but breach is major. You have not paid installment of the loan, promoters have not brought the necessary capital, or you have to bring down debt equity ratio to a certain level. Those are minor breaches, and the loan has become payable on demand. So the next thing we have to see, when was the breach rectified? Situation, breach was rectified after balance sheet date. Breach existed on the balance sheet date, rectified after the balance sheet date, but before the approval of the financial statement. That is called event after reporting period. And after the breach is rectified, now the loan will be repaid after 12 months from the reporting period. So what is the answer? So the answer is non-current liability, because breach got rectified before the balance sheet was approved, and now the loan is payable for more than 12 months from the balance sheet date. Non-current liability. Breach here does not affect classification. Now the student will immediately react. In case of extension, you said something else. In case of extension, you said check the condition on the balance sheet date, and on the balance sheet date, if you have not received the extension and the liability is payable within 12 months, it was current liability. Here there is a breach on balance sheet date, loan has become repayable on demand. So if I look at the condition on the balance sheet date, it should be current, but institute have made a change in the standard. Oh, This is a carve out. This is a carve out. In IFRS, they will say, look at the condition on the balance sheet date. On balance sheet date, there is a breach, the loan is repayable on demand, and therefore it is a current liability. But in India, we have protected our companies. We don't see rectification internationally after the balance sheet date. So this is a purposeful change in the standard made by Indian accounting standard. Reason you have understood, India is a land of defaulter. Okay. So many defaulters are there. And if suppose you apply international accounting standard as it is, these loans will become current liability, NPA in the books of bank. But for this company it will be current liability, and the loan amounts are also sizable. Thousands of crores of rupees are there, hundreds of crores of rupees are there. Their current ratio will go into fraction. It will become point something, not even 1. If I put all those loan into current liability, imagine showing a current ratio less than 1 in fraction. Would you be able to convince the potential investor and lenders to lend you money? If they lend you, they will charge high rate of interest also, because their risk goes up. Your credit rating will go down like anything. The credit rating companies will downgrade your rating, because one of the ratio they check is current ratio also, debt equity ratio, current ratio, return on equity, turnover ratios. So they will say this company has a poor liquidity, it won't be able to pay your liability. The first thing we are afraid of as a lender, are we going to recover my interest and principal on time or not? Nowadays companies take a lot of assets on lease also. You will not get assets on lease also, because lease payment also requires monthly payment, quarterly payment. So the lessor will say, boss, you don't have money to pay the lease liability, I will not give you asset on lease. You can't buy fixed asset, you can't take assets on lease, you can't purchase goods on credit, you can't take loan from the bank. What will happen to Indian business houses? It will go into trouble. Share market can collapse for some good company if they show poor liquidity. So to help them, this carve out was made. But they will never accept that in their accounting literature. They will simply say to make better presentation and blah blah blah. Situation number next. There was a breach on balance sheet date. It was rectified after approval of financial statement. Then current liability. Because the maximum amendment that we can make in our financial statement is up to the date the financial statements are approved by the board or approving authority. Beyond that, we cannot make changes in the financial statement. Easy to understand? Now next is, suppose there is a loan, but now the loan is payable within 12 months. Then such loan will be treated as current liability. 5 number was the easiest one. 6 number, lender has allowed grace period. Grace period means some more time to rectify your breaches. After balance sheet, grace period was allowed, but before approval of financial statement, which defer liability beyond 12 months. So lender says, okay, you can rectify. You have not yet rectified. They are allowing you grace period to rectify. Rectification of breach is different. Grace period to rectify the breach is different. So grace period is given, and because of which your liability will be paid beyond 12 months. Non-current liability. Next is, lender has allowed grace period before balance sheet date which defer liability beyond 12 months, same thing. So as long as your liability is deferred beyond 12 months from the balance sheet date, the grace period can be allowed before the balance sheet date or after balance sheet date, but before approval of the financial statement, we will call it non-current liability. Next, condition breached before balance sheet date and grace period received is less than 12 months. Grace period received is less than 12 months. Then the liability will be current liability. Condition breached before balance sheet date, but grace period is received is less than 12 months. And 9 number point, absence of actual breach of loan covenant. Absence means you have not yet committed a breach. You have not yet committed the default on the balance sheet date and grace period received is for less than 12 months. You have not yet committed the breach. You have not yet committed the breach, but you can go to the bank even before the breach is committed and you take the grace period. Before the breach is committed, you got the grace for less than 12 months. So treatment will be non-current or current liability as the case may be. So here the answer is Ind AS does not deal with classification in case of expectation of breach. So one has to see when is the loan payable and accordingly do the classification. Is it right?
Does management expectation come here?
Does management expectation come here?
Yeah.
No, management expectation will not come here. You have to see when is the liability payable. Is it payable within 12 months or after 12 months? Okay, suppose my year ending date is 31st March and you received the grace period up to 30th June. So now on this date we will be able to identify whether it is a current or non-current. So see the position on this date, because you still have 30th June to rectify the breach. So on 31st March, is the liability payable within 12 months or more than 12 months? Okay, and here if the breach is committed, then another story will start, because here you have got the grace period before committing the breach.
But if the management knows that till 30th June also they cannot do anything.
The management knows, they will not tell anybody. If the management knows that we are going to commit breach, they are not going to be honest and go to the bank and say that. Is it right?
Yeah.
So what management thinks, expects, don't look at that, because see, you are a businessman ultimately and you have to protect the interest of the company. So many times they might not reveal some information unless it can be verified independently easily. Okay, so let us solve few questions. Keep that chart in front of you and that will help us to answer. I will ask you to revise this portion last day before the exam, because you might get confused. There are so many situations even a good professional will not be able to remember very clear cut. An entity has taken a loan facility from a bank which is to be repaid within a period of 9 months from the end of the reporting period. Wait, don't jump to conclusion. Prior to the end of the reporting period, the entity and the bank entered into an arrangement whereby the existing outstanding loan will unconditionally roll into new facility which expires after a period of 5 years. So it was payable within 9 months, but you go to the bank, you take the extension for 5 years unconditionally. So what will be the answer? How should such loan be classified in the balance sheet of the entity? Will the answer be different if the new facility is agreed upon after the end of the reporting period? So this answer will be non-current liability, but this answer will be current liability, because on the reporting date, the liability is current. See the situation on the reporting date, except in case of breach which got rectified before the financial statement was approved. That is an exception they have made. Will the answer to A be different if the existing facilities from one bank and the new facilities from another bank? So existing facility will become current liability. New facility will be current or non-current as the case may be, depending upon the terms and condition. D. Will the answer to A be different if the new facility is not yet tied up with the existing bank? Not yet tied up, but the entity has the potential to refinance the obligation. It will be current liability. The existing loan will be current liability, and you are expecting that you will get the refinancing. Expectation will not be the basis for classification. Is it right? On the balance sheet date, the liability is payable within 12 months, and you are anticipating that there will be a potential refinancing. Potential refinancing will not be taken into consideration. A similar question was asked in the exam also. So I will read the answer because this is an important question. First, case A was extension received before balance sheet date for a period of 5 years. The loan is not due for payment at the end of the reporting period. The entity and the bank have agreed for the said rollover prior to the end of the reporting period for a period of 5 years. Now the entity has unconditional right to defer the settlement of liability for at least 12 months after the reporting period. Do you agree that the loan will be classified as non-current? Yes. Case B is actually extension after balance sheet date but before approval. Will the answer change? The answer is yes. The answer will be different if the rollover is agreed after the end of the reporting period. Underline this line, otherwise some student will say it is still non-current. Assessment is required to be made based on the terms of the existing loan facility. So you have to look at on the reporting date, does the entity have an unconditional right to defer the settlement for at least 12 months? No. Loan will be classified as current. So this is a dangerous question. Some student will say, as per Ind AS 10, event after reporting period, as the extension was achieved after the reporting date but before financial statement was approved, hence it is an adjusting event, hence it is a non-current liability. Standard says otherwise. Look at the condition on the balance sheet date. Okay, one more case. See, refinancing of the new bank from a new bank. So will your answer of A change? Yes. Loan facility arranged with new bank cannot be treated as refinancing, as the loan with the earlier bank will have to be settled, which may coincide with the loan facility arranged with a new bank. So what is the answer? The first loan, which is to be repaid within 9 months, will be classified as current. And case D, company says we have a potential to refinance the obligation. Will the answer of A change? Again the answer is yes. Potential refinancing possibilities are not considered, as on the balance sheet date the loan is payable within 12 months. So this is because refinancing or rolling over the obligation is not at the discretion of the entity. The entity does not consider the potential to refinance the obligation and classifies the obligation as current. So if the entity would have the discretion, then non-current. Then there is one more question, number 30, on this topic of loan. All questions are from either study material or RTP, MTP and exam. This also important. Entity X has taken loan 10% short-term loan of 10 lakh from a bank, which will fall due for payment on 30th June 2021. Entity finalizes accounts every March. Underline this. Entity has the discretion to roll over the loan till 30th June 2022. So what is my year end date in this problem? 31st March 21. And you have discretion to roll over the loan till 30th June 2022. That is, your 12 months will end on 31st March 22. So you can extend the payment of the loan beyond 12 months. This is 12 months. This is beyond 12 months. So now my learned students will reply. Is it current or non-current? It is due for payment on 30th June here. But then you can extend it unconditionally beyond 12 months. So therefore the answer is, it will be non-current. Understood? Concept has to be clear, then you can answer. So you will write answer like this: as per Ind AS 1, loan is classified as non-current because entity enjoys the discretion to roll over the loan for a period more than 12 months after the reporting period. However, when refinancing or rolling over of the obligation is not at the discretion of the entity, suppose they would have added one more question, that this rollover is not at the discretion of the entity, then the answer will be current, because then it is payable after 3 months from the reporting date, within 12 months. Good question. Question number 31 also important. You must revise before the exam. In December 20x1, entity entered into a loan agreement with a bank. So this is December 20x1. Then the loan is payable in 3 equal annual installments starting from December 20x5. One of the loan covenant, means condition, is that an amount equivalent to the loan amount should be contributed by the promoter by 24th March 20x2. So this is 24th March and this is my year end date 31st March, following which the loan becomes payable on demand. As on 31st March 20x4, the entity had not been able to get the promoter's contribution. So there is a breach. Loan covenant is breached before the balance sheet date. Then we'll see what happened. On 25th March 2002, entity approached the bank and obtained a grace period up to June 30th. Grace period up to June 30th 2002. So grace period is up to what date? 20x2. So breach was committed, but the grace period is only for 3 months. Grace period is only for 3 months and breach has already been committed. Now the question is, the bank cannot demand immediate payment during the grace period. The entity reporting period ends on 31st March 2002. Now one very good question is, as on 31st March 2002, how will the entity classify the loan? This is 31st March 2. Grace period is up to only 30th June 2002 and the breach was committed on 24th March x2. Breach committed. Breach has not been rectified and grace period is only 3 months, not more than 12 months from the balance sheet date. So anybody who would be answering first answer? Current or non-current? Current liability. assume that in anticipation that it may not be able to get the promoter's contribution by the due date. Suppose the company knew that it will not be able to bring money in February 20x2. Here only, before 24th March, entity approached the bank and got the compliance date extended up to 30th June 2002. So does the breach occurred here?
No.
Breach did not occur, because before the breach could occur, you got the grace period extended up to 30th June. Breach did not occur. Before the breach occurred, you got the grace period, which is now up to 30th June for getting promoter's contribution. In this case, will the loan classification be different from A above? This breach did not occur only. Loan is not yet repayable on demand only. We will see on 30th June now whether the company commits the breach or not. So there is no breach right now, because before the breach is committed, you have taken the grace period which is up to 30th June. So as on 31st March, breach does not exist. No breach took place. Whereas in the first case, the breach has taken place and the grace period is less than 12 months from the balance sheet date. So the answer is non-current liability. Yes or no? Only if you have read line by line, you will be able to get the answer. So first answer will read, where condition was breached, underline the word breached, before balance sheet date and grace period is less than 12 months. But if the same question says grace period is more than 12 months, then non-current liability. So Ind AS 1 says entity classifies the liability as non-current if the lender agreed by the end of the reporting period to provide a period of grace ending at least 12 months after the reporting period, within which the entity can rectify the breach and during which the lender cannot demand immediate repayment. But in the present case, what happened? Following the default, grace period within which entity can rectify the breach is less than 12 months. That means still the bank can ask for the payment of the loan. Hence the loan will be treated as current. Breach committed, grace period received. Grace period is less than 12 months from the balance sheet date, current. Breach committed, grace period received more than 12 months from balance sheet, non-current. Before committing the breach, only if you receive the grace period, then on the balance sheet date the breach does not exist, non-current. That is my case B, absence of actual breach of the loan covenant as on the balance sheet date and grace period is less than 12 months. Ind AS 1 deals with classification of liability as current or non-current, underline, in case of breach of a loan covenant. If the breach occurs, but there is no breach in this problem, please remember, there is no breach. It does not deal with classification in case of expectation of the breach. If before the date 24th March you got the grace period, breach did not occur. So liability is not yet current liability. In this case, whether actual breach has taken place or not will be checked on 30th June, that is after reporting date. Consequently, in the absence of actual breach of loan covenant, loan will continue to be classified as non-current. Very good question number 31, and now again a very good question number 32. So we are trying to explain different situation through examples. Company A has taken a long-term loan arrangement from Company B in the month of December 20x1. There has been a breach of material provision of the agreement. So it's a material breach. When? December 31st. As a consequence of which the loan becomes payable on demand. So December X1 breach.
First paragraph.
First paragraph is cancel. It is just repeated from question number 30. Cancel the first 3 lines. I don't know what happened to my software this time. In many questions, the first few lines are automatically getting copied from some earlier question. When I gave the note for printing, it was not there. So the second paragraph is the starting point. If in your book anything else is printed, delete it. So I will just read the problem again. Company A has taken a long-term loan arrangement from Company B in December 20x1. There has been a breach of material provision. And what is your year ending date? March 31st. Whether the breach is rectified by that date?
No.
No. And the loan becomes payable on demand. Here. In May 2002, the company started negotiation with Company B for not to demand payment as a consequence of the breach. The financial statements were approved in the month of June. So June 2000X2 financial statements are approved. This is year end date. This is date of approval. And the negotiation was started in May. But what happened to that negotiation? In the month of July, oh my God, is July 1st or June 1st? That means up to June the breach was not rectified. Both company agreed that payment will not be demanded immediately as a consequence of the breach of material provision. Advise the classification of the liability as current or non-current. So this will be current because you can rectify the breach before the approval of the financial statement. So dates are important in this question. The two parties agreed to that the loan is not to be demanded immediately, but after the approval. Once the date of approval of financial statement is over, we cannot make adjustment in the financial statement for 31st March 20X2. So the loan will be treated as current. In your exam, suppose it says that the two parties agreed before June 20X2, then it will become non-current because of the carve out made in the standard. Is it right? So will you be reading this answer as homework? Yes, sir. Next question number 33. Homework, not homework, classwork. Source study material. OMN Limited had a subsidiary. MN Limited, ONM provides a loan to MN Limited at 8%. OMN has a subsidiary MN. It has given a loan to subsidiary at 8% interest. Loan is required to be paid whenever demanded by OM. So loan is payable on demand. This question is interesting because many students will write for both party it is a current asset and current liability. No. For the borrower it is a current liability because there is no unconditional right to defer the payment. But for the lender it can be current or non-current depending upon the expectation. If the parent company does not want to take the loan back, then it will show non-current. Show whether the loan be how the loan will be classified in the financial statement of OMN Limited. So OMN will show it current or non-current depending on expectation. But if the question is how the subsidiary will classify it, the subsidiary will always classify it as a current liability because subsidiary does not have discretion to defer it beyond 12 months. They have written here also. Will it be different for MN? So today you will read the answer as homework. We have hammered this point on your head, okay? And trust me, one of these questions can be asked in your exam because generally this is the area from where they are asking question, and one or two more areas. So the answer I have explained. We'll come to now some small issues, like for example share capital. What are the presentation and disclosure requirement for share capital as per Ind AS 1? It is very similar to Schedule 3 Division 2. Okay. So information related to share capital will be disclosed in either balance sheet, or you can disclose in the statement of changes in equity as a part of balance sheet or in the notes. But where do we present it as per Schedule 3? As a part of statement of changes in equity. So practically companies will follow this, although the standard says balance sheet, SOCI or in notes. And then you have to give a description of the nature and purpose of each reserve within equity should be disclosed. So in India we have different types of reserve: capital reserve, revaluation reserve. Some companies create some more. So their nature and purpose will be disclosed. Then following needs to be presented for each class of share capital. This is there in your Schedule 3 Division 2 also. You have studied in intermediate classes also. Number of share authorized, number of share issued. Out of that, fully paid, issued but not fully paid means partly paid. You have to disclose par value per share, whether 10 rupees, 5 rupees or shares that have no par value. They are called stock. If share does not have face value, it is called stock. Then a reconciliation of the number, opening balance, share issued, share bought back, whatever changes have happened in the share capital that you have to disclose. Then if shares have rights, preference, restriction, that will be disclosed. Like equity shares are of two types: equity share with voting right, equity share with differential voting rights. Preference shares are of different types, that will be disclosed. If there is restriction etc., disclose. Shares in the entity held by itself or its subsidiary or associate. If a company is holding your own share, which is not allowed in India, you cannot invest in your own company share. If you buy back, you have to cancel. But as per Ind AS, they have said, because in some other countries, company can invest in own share also and they need not cancel it. Later on, they can sell it at a profit also. But in India, that is not allowed. Otherwise, companies will, instead of focusing on core business, they will start trading on their own shares only. Okay. If the shares of the parent is held by subsidiary, disclose. If the share of parent is held by associate company, disclose. Then shares reserved for issue under option and contracts for sale of share. In case if you have issued, for example, ESOP, disclose that. If you have any other contract where share will be issued, disclose, because in future the stake of the existing shareholders will get diluted. It will result into diluted EPS. Let the users know in advance that in future some more shares will get issued, which will reduce EPS, which will reduce his percentage holding, which may reduce the market value of the share also. Because if EPS falls, market price will fall. Then statement of profit and loss. I'll go little quickly because we have already discussed in Schedule 3 Division 2. In some countries there are two formats, one for profit and loss, one for OCI, but we have decided to follow a single statement approach. In the same format we'll have profit and loss and OCI, it is called SOPL, statement of profit and loss. How do you present expenses? Expenses will be recognized in the P&L account on the basis of nature of expense. Underline, I have done it for you. Nature of expense, not function wise. Not function wise. In some countries they allow function wise expense. Like what is function wise expense? Administrative expense, selling expense, distribution expense, production expense. In India we don't do that. We say purchase, depreciation, then finance expense, other expense. In other expense all expenses are put without showing separately for each function. That is what we follow. IAS allows two, function wise, nature wise. We allow only nature wise. Under nature of expense method, line item of expenses represent aggregation of expenses according to their nature. For example, we write employee benefit expense. Now that employee benefit expense can be related to selling activity, production activity or administrative activity. So we will present like purchase of material, employee benefit. Example of classification using nature of expense. So I have just given one example. This is what we follow as per Schedule 3 Division 2: revenue, other income, change in inventory, raw material and consumable consumed, employee benefit expense, depreciation and amortization, other expense, total expense, PBT. Now one note here I have mentioned, no item will be presented as extraordinary item. Extraordinary item was in accounting standard. Now there is no concept of extraordinary item. Then the statement should begin with operating item and then non-operating item, and should end with items of OCI and their related tax effect. So first part is your profit and loss, which is basically the intentional income and expense item, operating item. The second part is OCI. OCI, an entity shall present the following item as allocation of profit and loss and OCI. Now this will be applicable in CFS. What is CFS? Consolidated financial statement. In consolidated financial statement, your total profit will be divided between parent company and NCI. Total OCI will be divided between parent and NCI. That is, out of the total profit of the group, how much belongs to parent and how much belong to non-controlling interest, means minority shareholder of subsidiary. Is it right? Then we have information to be given in profit and loss section. I have made a small list, okay. What are the information you will write in statement of profit and loss? One is revenue, which is presented separately from interest revenue. Interest revenue will be calculated using effective interest method, which is IRR. We are going to cover that very soon in Ind AS 32 and Ind AS 109. Then we will disclose gain and losses from derecognition of financial asset measured at amortized cost. Write Ind AS 109. Do not ask me today, sir, what is financial asset measured at amortized cost. This is one of the categories of financial asset. Financial assets are of three categories: FVTPL. FVT OCI and financial asset carried at amortized cost, means at cost subject to some adjustment. Then you will disclose finance cost in P&L account. Then you will disclose impairment losses, also reversal of impairment losses or impairment gain as per Ind AS, right on Ind AS 36. Then you will disclose share of profit or loss of associate and joint venture accounted for using the equity method. If you have associate, if you have joint venture, if they earn profit, you will record your share in the profit or loss. So their profit you will record in P&L account part, their OCI will be recorded in your OCI part, your share. More about that in Ind AS 28. In Ind AS 28 we will learn how to consolidate associate and joint venture. Very easy standard. Then this point right now you will not understand. So I will skip it because this will be totally covered in Ind AS 109. Reclassification of financial asset. Reclassification means your FVTPL can become FVT OCI. FVT OCI can become FVTPL, because of which there is a profit and loss on reclassification. So that is also presented in profit and loss. So don't worry, once you complete other standards, come back to this standard and whatever you have not understood you will understand, because other standards are referred. Same thing here also, reclassification from one category to other category may result into profit and loss, and that is shown in P&L account. Then you will disclose tax expense, and you will also disclose a single amount for the total of discontinued operation. Which standard deals with that? Ind AS 105. So if you have some discontinued operation in the P&L account, first you will compute profit from continued operation. Here you will write all the details, sales, expense, and you will also add profit or loss from discontinued. Here I will write the net profit directly, subject to tax expense also. Here I will not write sale expense separately. We will do that working, but the net profit or loss will be disclosed less tax expense. Is it right? So this was about profit and loss account. I have not written many items, don't worry. Then the next item is OCI. Write down read as homework. Read as homework, because OCI I have already covered in schedule 3 division 2. So today we will stop here. Tomorrow I will quickly revise this portion, and after that we will take question number 34 also, and some more theory paragraphs are pending, and then the standard will be over. So today you can try. There are some questions for cell practice. So when you get time, you revise those cell practice question also. Okay. So in the next lecture we can finish it in next 15 to 20 minutes, and then we'll start another standard. Okay.
Yes, sir.
So thank you very much. See you tomorrow at the same time. Okay, same time like today. Are you ready?
Yes, sir.
Student at home, are you ready for the same timing? Say yes. So I have got one person saying yes. What about the other person? Are you ready? Yes. Both the student have said yes. So thank you. We'll continue tomorrow. Bye bye.